Yeah, 42.50. I mean, I've been on the show, I think, over the last month and a half and talking about how big this level is. This is the close on March 6th, the scene of the crime where Saudi Arabia announced the price war over the weekend and crude gap lower and royal global markets. But not a whole lot is expected from this OPEC meeting. I mean, the JMMC is really actually talking about how high the compliance has been.
Yeah.
So nothing really expected out of it. The inventory data for last week was less of a draw officially than some of the API numbers too. So that was kept it controlled below that. And then obviously the broader risk environment yesterday after the Fed, we saw that come in just a bit too.
Yeah, Bill, you bring up a good point. This was not a policy meeting. This was more a compliance review meeting. So maybe not necessarily the market mover that one would hope for. But let's talk about those draws this week. You mentioned, I think it was the fourth week in a row for the API and for the EIA. What's that telling you in terms of the demand narrative?
It's been steady demand for U.S. crude, and the dollar's weaker, and that's one of the things you're hearing up too. Another story was with U.S. and China trade tensions, but actually coming out of a lot of this is we're expecting China to actually purchase more U.S. crude, closer to what they should have been, and that's really because of the weaker U.S. dollar. So that's something where U.S. exports have been high. Now, those exports did fall back a little bit from week to week on the data yesterday. But the growing U.S. exports have been a big catalyst in seeing these drawdowns of U.S. supply. Cushing, though, really what hasn't been drawing down. So that's something to keep a bit of an eye on, too. Overall, though, gasoline was trading lower into that number. And I think it spiked, if I remember correctly, about 2 cents, right when that thing happened, and that was a big draw, 3.5 million barrels or so in gasoline. So that kind of stabilized things despite the less of a draw than crude.
How much are you watching the move up in natural gas, Bill?
I'm actually watching it real closely. We've been riding this thing really nice. It's one of those trades where fundamentally heading into today's numbers, we haven't seen the lower injections. So fundamentally, from that standpoint, if you're long, which we have been taking some off the table here, and you can't, or really most of the position off the table here at this point, because you got the headlines, the blackouts in California, some of the arb trade out there too is with in the cash market has been supportive. So you have those supportive narratives, but the real underlying fundamentals heading into the second half of the year is we're not seeing, the injections have been pretty steady. So the supply is there, and that overshadows this rally. You'd always like to think, and if you're ever trading natural gas, especially if you're using some options, you'd always like to hope to catch that big move. But you can't trade on hope, so you got to manage your position, I think, heading into today's numbers.
Yeah, well, it certainly has been trending higher. And speaking of today's number in terms of natural gas, they're looking for a build of about 43 billion cubic feet. Last week, we saw a build of, 58 billion cubic feet. We're talking commodities, Bill. Let's talk copper. We just mentioned the rally in natural gas. This Dr. Copper is back up above the $3 level, or was briefly this week. I'd imagine that speaks to some of the demand narrative that you were talking about in terms of the inventories, in terms of crude, and it also feeds into that, some of what we've been seeing in terms of the housing numbers as well.
Yeah, copper, I mean, on a charting standpoint, you saw this thing twice, had days of about 10 cents. It got hammered. And the next day, each time,
came
over the
right
past
back.
2 weeks,
yeah,
it bounced right back. It could, and that shows you some of the underlying fundamentals within that market. I mean, there's obviously some concern with South American supply, in the mining there because of the COVID-19. So that's keeping that was really a big driver through the spring and helping in copper recover. But then as well, there was some new data that said that China's output, the refined output of copper, fell about 5.3% in July. So that was a big catalyst. And then on top of everything, China announced stimulus on coming out of the weekend. And although the stimulus, the headline number, $100 billion worth, you grabbed the markets, and that was a big catalyst. It was really only a small net amount of $25 billion. But when you get the headlines going and path of least resistance, a lot of these markets higher, and headlines and the algos feed on it. So you see this move. And then there's actually a really nice bull flag pattern where this thing broke out above when it moved through there, not yesterday, but the day before, and that really gathered some steam. $3 is a big level, though, and I think this time up here, I wouldn't be chasing it to get long. I think we come in a bit. I wouldn't be surprised to retest where that broke out of from that bull flag, maybe about 290 or so, and that could be a good inflection point for copper and broader markets.
Yeah, we're looking at that right now, looking at the daily time frame actually here, but the nice move up and through the breakout there. You mentioned the road that copper has been following on the path of least resistance. It's paved with a weaker dollar as well right now for the most part, but that momentum to the downside has been slowing. So I guess this kind of speaks to some of the other contributing factors that you mentioned, some of the supplies declining as copper has been and continues to be rallying. Bill, talk to us a little bit before we let you get out of here about in terms of today, the jobless claims, the impact that this could have on, well, I'd imagine it'd be more directly tied to gold than any of the other products that we've been talking about. It also lost some of its momentum to the upside after topping out around that 2090 level. I think it was 2089.20 is the all-time high, the record high there. But it sold off a little bit yesterday in reaction to the Fed. Why do you think?
Well, before I get into the trader's paradise that gold's been, it's something I really think that's actually pretty cool. Overlay the charts in Tesla and copper.
Okay.
These things, unbelievable how closely they've tracked. Obviously, the percentage moves in them are different, so ignore the percentage moves. But the day-by-day overlay, check that out. I mean, if you're at home, you want to overlay that. It's a really cool thing to look at. But gold, to answer your question, gold's been a trader's paradise. It really has been. And I mean, I've been bullish gold, Blue Line Futures. We've been bullish gold, extremely bullish gold. And we write our research saying unequivocally bullish gold since August of 2018. And, you know, I always say you don't want to chase gold when everybody's screaming for it. So really, this breakout is where you want to be capitalizing. But overall, the technicals have been really tremendous, and you can kind of see the momentum intraday building, and it really gives you a great opportunity to trade. Gold just traded right up to where it broke down last week, stalled there, started falling, and even if you didn't fade it and pick a top, you didn't need to. You had an opportunity to sell it yesterday, and even post FOMC minutes when that thing spiked and it came in a bit, and then you could jump on some momentum and even fade it. So we've been trading gold from both sides. Take a look at the technicals. Know your stops though, because ultimately we really want to be long gold. And one of the greatest ways I think you can play it as an investor here using futures is use the micro contracts. And per $25,000 that you may be playing with, you can look at about 1910, 1905. Look in there, buy 2 micro gold December contracts, and then put another order for 2 micro gold contracts down at 1855, and just let those be. Put your stop down at 1790. You're risking about $3,500 to $4,000 depending on where you put your stop and where exactly you enter it. But then target 2,300 to the upside. Talking about a $15,000 to $16,000 gain. So that is, I think, the really greatest trade. That's one of the things that we're telling a lot of people, because a lot of people are calling us here. How can I get in gold? And you know, we want to say, you know, you're looking from an investment standpoint because commodities have a lot of leverage. So it's one of those things you want to understand what you're doing in gold. Because I've seen some people come in, open accounts, and then they get beat up in the swings trying to trade it too large. Know the size and the leverage you're holding in the gold market, because I think it is higher to go. Yesterday's news, they're not going to do the yield curve control. Kind of, I think, was an encouragement for keeping the dollar, you know, buoying the dollar. A little pressure on gold there. Take a little bit of air out of the stocks as well.